My name is Ben Sutton. I'm an accountant and one of the founders here at Mazuma USA. And we are, of course, here to help small business owners with their accounting and tax needs. And one of our consistent recurring topics is obviously how to minimize the tax burden on our small business owners. And so today we are going to talk about how to minimize taxes by utilizing retirement plans. All right, and so I've got three different types of retirement plans that are commonly used. I'll give you my opinion on which one is best, but it doesn't really mean the others aren't good for certain situations either. But so as a small business owner, obviously you want to make money and you want to keep as much of that money as possible. And running a small business isn't just about paying the bills today, it's about saving for money in the future. And that's so our efforts to minimize taxes and save for retirement kind of align in this tool, this tax strategy tool of the retirement plan. The IRS has made special rules that allow you to defer taxes, meaning defer income, if you use specific types of retirement plans, okay, that they've designated and said if you're using this kind, then you can delay paying taxes on this money. So before I go into those and talk about that strategy, those specific retirement plans, I want to mention that this is a theory that's this strategy is based on the theory that paying taxes later is better than paying taxes now. Okay, and that's a debated theory. Some people think, no, it's better to just pay the taxes now and then get the money tax-free later. Others, but I would say the majority of practitioners and, of course, financial advisors who are incentivized by you putting money into these accounts, they say, the majority of people say, it's better to defer that income and push it off into the future. So that you have more money in your pocket now. And that's kind of based on two things. One, the belief that taxes are going to be higher lower in the future, or about the same as they are now, right? If the tax rate today is 20%, and 5 years from now it's going to be 50%, then obviously it'd be better to pay taxes now than later. But we assume that the tax rates aren't going to fluctuate that much, and so paying it later is better in that scenario. The other reason later is better is inflation. Okay, your money, the money that you have now today, is worth more than the money, that same dollar, 5 years from now, because of inflation, because the cost of everything goes up. So the idea of paying later is appealing because you're paying with cheaper dollars later. And of course, there's the natural effect of, we live in the present and we don't know what's going to happen in the future. Might as well hold on to as much as you can today. All right. So these retirement plans and this tax strategy is based on that fundamental that you're just pushing the tax bill into the future with these retirement contributions. They're lowering your tax bill today, but it's not making the taxes go away. It's just pushing them off into the future. Okay, so if you find yourself, if you can adhere to that theory and you like that idea, then these three plans are something you may want to consider. So first plan that I'm going to mention is the 401k. Okay, so we've probably heard that before. Big companies have 401ks for their employees, and it's a common benefit that employees of companies often get. There is, where this comes to the small business is, where this really applies to you is the idea of a solo 401k. So you might have heard of this option where if it's just you and the spouse who own and run this business and there's no other employees, you can set up a solo 401k that is really just there to serve you and your spouse. Okay? So with the 401k, you have the ability to defer income as the employee of the business, okay? Or, and in addition to that, defer income as the employer. As a solo owner, you're both, right? So you get to defer income as an employee and defer income as an employer. For the employee portion, you get to put aside up to $19,500 if you're under 50. If you're over 50, you can put away $26,000. And so you can do 19.5, and as an employer, you can put an additional 25% of your compensation away into this retirement plan. Okay, so if I earn $100,000 of income in my business, I can put aside $19,500 plus $25,000. Okay, and these numbers are rough, but this is essentially how it works out. So I can get, almost $40,000, $45,000 into that retirement plan and reduce my current year tax bill by $45,000 in doing so. All right, so, and if I earn more than $100,000, I can still do 19.5 as an employee and 25% of that higher amount, but the maximum, the cap, is $57,000 that I can get into this 401k plan. Okay, and that $57,000 is kind of a cap across most retirement plans. So 401k, solo 401k can be a good option. One of the downsides to the 401k is that it's a little bit more burdensome on the administrative side. The plan document that needs to be set up in order to comply with the IRS's rules around 401ks is more extensive. And also, if you get over $250,000 in this plan, you have to file an annual 5,500 tax return for the 401k itself. So there's an extra tax return associated with 401k plans over $250,000, with over $250,000 in them. So that kind of takes away some of the appeal of the 401k. But still, they can be great tools. Before I move on to the next plan, I'm going to kind of take a step back here and say, okay, what does it mean to establish a retirement plan, and how do you get money into it, and how does that work? Who's watching? Where does that money go? Typically, you will establish your retirement plan, whether it's a 401k or any other type, with a financial advisor or a custodian of some kind, like Fidelity or Vanguard, or these large brokerage houses that have mutual funds and things. You will establish a retirement plan with them, and you contact them. Some have online forms. You can just fill out the form and establish it yourself. Others, you can go to financial advisors who work for these large brokerage houses, and they'll explain the rules to you and get it set up for you. And so that plan is registered with a brokerage, and that brokerage acts as the custodian of your retirement funds. So, the 19,500 that you get to put in there, and plus the 25,000 from the employer, the funds that you're eligible to contribute get paid into that brokerage house. All right, and you can then direct them on where to place those funds, like a mutual fund or specific stock. You can direct where those funds live and try and earn a return. But the important thing is that the money's going into that custodian. So you're establishing the retirement plan with a custodian, either directly on their website or with an advisor who's representing that custodian, and they're creating your plan document and establishing all the rules of your plan with you, and then you're paying the money to them when it comes time to contribute. Okay, so back to our plan options here. So solo 401k. I explained the details of that. We'll now move on to the next one, which is probably the most common and the one that I most often recommend, and that's the SEP-IRA. Okay, this one's a little bit different. You don't have the employee and employer both contributing to this plan. With the SEP-IRA, it's only the employer. Okay, and you've got that same 25% compensation limit. So if you are the only owner of this company, and you're the only one pulling money out as compensation, and you earn $100,000. I'm using that just because it's a round number. It doesn't have to be that high. You can, and you in your plan, you say you're going to contribute 25% of your compensation into the plan. Then at the end of the year, you can put $25,000 into the plan and reduce your taxable income by approximately $25,000 by doing so. Okay. Again, there's the same max of $57,000. You can't put in more than $57,000 a year. And with the SEP-IRA, there's no filing requirement. So there's no risk of having to fill out a tax return for this SEP-IRA. So the major difference there between the 401k and the SEP is that there's no employee deferral, right? And so that kind of means you have to be making more money to get more in, to get the same amount in as you'd be able to put in with the 401k. There's only the employer deferral contribution in a SEP-IRA, but no filing requirement, and it's kind of a simpler deal. I'll mention one thing here. If you decide that your plan is going to be a 25% rate contribution for you as the owner, that same rate applies to any other employees that you have. All right, so you got to kind of take that into account. The percentage, the rate that you decide on, is a percentage of compensation, though. Okay, so if your employee is making a lot less than you are, then their percentage, the amount you're putting in for them is going to be less than the amount you're putting in for yourself, but the rate has to be the same for both of you. All right, so SEP-IRA, only the employer can contribute, can be up to 25% of compensation, and a maximum of $57,000 can be put in. And there's no filing requirement on the SEP. Next one is the simple IRA. These are less common, but can be great. With the simple IRA, you're back to employee and employer deferring. So that means the employee is putting in their own money, and the employer is matching up to 3% of the employee's compensation. Okay, with the simple IRA. I don't know where they came up with these numbers, but that's the limit for the employer compensation on a simple, and that's probably why we don't see them used as much for sole owner operator businesses, is because 3%, that's like nothing to, when you're trying to get money into this account to reduce your taxes. So the employee can put a max of $13,500. Employer can match up to 3% of their compensation. No filing requirement for the simple either. So that plan is more often seen with when there's lots of employees, because the employer contribution is much lower, but still the employee can get in, $13,500. No filing requirement already on the simple. I think I already mentioned that. Last thing I'm going to mention on these plans that probably will factor into your year-end tax planning is the effective date. Like, when do you have to have these set up, and when do you have to actually put the money in, right? So for a 401k, you have to have it set up by the end of the year, okay? The 401k plan must be set up, organized with the custodian before the end of the year if you're going to be able to put money into it. So coming up on the end of 2020, I have to have the 401k in established before December 31st if I'm going to use it to reduce my 2020 income. All right. I don't have to put the money in until the tax deadline next year. So I can, for a 401k, as long as the plan is established before the end of the year, I can wait to put the money, actually give the money to the custodian until my business tax return is due. And that's the extended deadline. So if I extend my business tax return until September 15th, I've got all the way until September 15th to put my 2020 contribution into the account. And that, and I still get to reduce my 2020 tax bill, even though I didn't put it in until September of 2021. Okay. For a SEP-IRA, I don't have to have that one established by the end of the year. I just have to have that one established before the tax deadline. Okay, and the contribution rule is the same. So I have more time to establish that. I don't have to rush and get it done before the end of the year. I can wait until after the end of the year, after the end of 2020, and say, oh, I've got enough money. I think I'm going to do this. Establish the plan in February, put the money in February, and I get a deduction on last year's income, my 2020 tax return. The simple IRA, you've got to establish that by October 1st of every year. And unless you start your business after October 1st, then you need to just do it as soon as possible. But October 1st is kind of the cutoff for businesses that have already been operating. Same contribution deadlines apply. You don't have to actually put the money in there until the next year before you file your business tax return. All right. So hopefully that, I know that's a lot of information, and these things do get complicated, but that's why I'll often suggest going to a financial advisor to get them set up, just so that you can dot your I's, cross your T's, and make sure that you're not missing anything major. But retirement plans often end up being a significant tax reduction strategy when a business owner ends the end of the year with a killer year. They've had a great year. They've got lots of money flowing in, lots of cash in the bank, and they're staring at a very high tax bill. You can get that tax bill down substantially if you can get a $50,000, $57,000 deduction by putting that money into a retirement plan. Yes, like I said, later when you're pulling the money out after you're 65, because that's the other issue with these. Once you put money in there and you get that deduction, the expectation is that you're not pulling that money out until you retire. which is about 65 years old, right? So when you start pulling that money out when you're 65, then you're paying the taxes on it, right? Whatever tax rates apply in that future year, you're paying those taxes as you pull the money out. If you have to pull the money out before you retire, that's when you get the 10% penalty on top of the tax bill. So you really don't want to, putting this money away is not, shouldn't be done hastily. You should think through it. This money's kind of being locked up a little bit until you retire, or else you're going to be penalized significantly for pulling it out. All right, so hopefully that gets you oriented with the common retirement plans that are available: 401k, SEP-IRA, simple IRA. SEP-IRA is probably my favorite, my most commonly recommended one for the low administrative burden and kind of the more simpler approach. But so hopefully that helps you. We'll get now into your questions. We're going to go till about 3:15. Hopefully we can answer all your questions. Any that we don't answer, any clients who maybe are on and want to ask for additional information about this can always log into their portal, initiate a chat right there, and get connected with the tax pro at some point to have a dialogue about this and answer your questions. First one is, can I contribute to a SEP-IRA if my business takes a loss on the tax return that year? You can. It depends on your situation. If you're an employee of the business, so if it's an S corporation or a C corporation, then you should be getting payroll out of the company. So if you've got a paycheck coming to you, then it doesn't matter if the business incurs a loss or not. You got paid compensation. And the limit on a SEP-IRA is 25 up to 25% of compensation. So your W-2 wage is what determines how much you are able to contribute. If you're not an employee of the business and you're talking about a sole proprietor or a single member LLC, or even multi-member LLC, then you won't have any compensation to be able to contribute based on. So hopefully that answers that for you. Next one, can all LLCs, single member LLCs, be eligible for the solo 401k? Yes. Yes, you can. Next, because I thought, quick clarification, because I thought SEP-IRA, it was 20% for the owners, 25% for all other employees. No, it's 20%, 25% max for everyone. I'm not sure if you're referring to, as a sole proprietor and single member LLC, there's a little bit of a calculation that you have to go through to determine the exact rate that the business owner can contribute for themselves. So it does vary a little bit from the 25. It could drop down a little bit for the 25% for the owner. But as far as the IRS rules are concerned, 25% is the rate for everyone. Next one, can I open multiple retirement accounts if I want to maximize a contribution? Great question. The $57,000 limit that I mentioned is across the board. So you can have 5 retirement plans that you're contributing to, but as soon as your aggregate contribution gets up to $57,000, you're done. Okay, so that doesn't apply. I did not hear anything about a Roth IRA. Did I miss this? No, that's a great question. So a Roth IRA is a retirement vehicle that is not necessarily a business retirement plan, right? It's not in and of itself designated as a business retirement plan that's traditionally used. The Roth IRA is an after-tax retirement plan, so an individual plan usually, but there's no tax savings that comes with a Roth IRA. That's a great. That's the Roth is for people who want to pay the taxes now instead of paying them later on this money, right? So it's still definitely a great plan for people who don't like this idea of kicking the can down the road. But it kind of falls outside the scope of our tax planning strategy here and how to save taxes. All right, next one. Can you discuss solo 401k and solo Roth? So yeah, the difference there is what I just mentioned. The Roth, same rules apply, but it's you're not deferring any taxes with the Roth. Next question, what if you have only one other employee who's not a spouse and want to have a 401k like the solo? Is this possible? I do not believe so. The solo 401k, it can only be for a company that has no employees or where the spouse is the only other employee of the company. You may want to consider, the SEP, or depending on what your objectives are there. Next one, how do you open the SEP IRA? I was late. So all of these retirement plans are going to be opened with a custodian of some kind, which is a brokerage house, like Fidelity, Vanguard. I don't want to favor them, but those are the only ones that can come to mind. We're not sponsored by any of them. But these large investment brokerages that they administer, they are the custodians of these plans. So you go to them either directly on their website, or I usually recommend going to a financial advisor so that you have an agent that you can ask questions and who can explain any nuances or rules to you about the plan. So you go to those brokerage firms, set up the plan with them, and then contribute the money to them when it's time to pay the funds. Next one, I just turned 65, so all this may not apply to me. I am not now on Social Security. I'm just starting a new business. Are there any alternatives to what you just shared? You can still create these retirement plans and contribute to them. So even though you're 65, that's still possible. You just don't have that as much time ahead of you to defer. If you're 65 and working now and started a business and you're planning on having to pull this money out, maybe pulling this money out when you retire at 70 or in your early 70s, you're going to be paying these taxes within the next 5 to 10 years, right? As opposed to someone maybe earlier on who can defer it 20 or 30 years. So it still applies to you. And there are other tax minimizing strategies, obviously, besides retirement plans, but they're kind of beyond the scope of this presentation. Next one, I had a Roth IRA set up with my previous employer, but I'm now self-employed. Should I stop putting money into that and focus on a separate retirement plan, such as a SEP? It depends on if you like the idea of swallowing the tax pill now, or do you want to swallow the tax pill later, when you start pulling this money out? And if you can, so this comes down to opinion. What do you think tax rates are going to be later? If you think they're going to be lower later or not worse than they are now, then saving the taxes, eating the tax pill later and doing a SEP-IRA might be a good idea. If you're used to the Roth and you like the idea of just swallowing the tax pill now and being done with that, and then knowing that later when you pull this money out, you're not going to have to pay taxes on it then, and you'll have more to put in your pocket, then stick with the Roth that you've got now. I would say this is more of a personal opinion thing, and there's no real bad situation here. If you find yourself making more money, like a lot more money, and your current Roth IRA maybe is just a regular Roth IRA and not a Roth SEP or a Roth 401k, and it's preventing you from putting a lot of money in, like the limits I think now are like 6,500 or 7,000 for traditional IRA or regular Roth IRA plans. If you end up wanting to put more money in, you can set up a business Roth if you wanted. Okay, I have a SEP IRA established. Do I make the payments directly from the corporate bank account to the SEP account, or do I arrange it somehow through the bookkeeper with Mazuma? Assuming the former, what records do I need to provide Mazuma for accounting and tax purposes? Great question. You would pay, you make the payment directly from your business bank account to the custodian. Okay, and as your bookkeeper, as we see this transaction, this $5,000 payment to Fidelity or whoever your custodian is, we pick up, we need information from you to tell us that you have a retirement plan, but then we see, okay, here's the payment to the brokerage house. This is for the SEP contribution. We're going to code it accordingly in the books and report it properly on the tax return and make sure you get that deduction. All right, I was employed. Next one, I was employed on a W-2 till July 1st this year, and during this time maxed out my employer's 401k with my contributions of $19,500 plus $6,500 catch-up since I'm over 50. There was no employer match or any employer contribution. When I lost my job, I formed my own business as a single member LLC in August. Can I do a SEP-IRA with the 57K limit? Yes, you can. The $19,500 that you've already got in there plus the $6,500 counts towards that limit, but you've got another 30 grand that you can get in there if you set up the SEP-IRA under your single member LLC. Are there any good rules of thumb that you can use for determining which type of account is best for my business? So definitely if you've got employees besides yourself and your spouse, that's a major factor that comes into play with this. I would say if you are an employee already of the business, that's another factor. So if you've got an S Corp and you're already on payroll, that would make me lean towards the 401k. Whether you've got employees or not, that would make me lean towards the 401k, because you can start, if you've got good cash flow coming in, that you can get more into the 401k faster that way. That would probably, if you're not an employee of the business, then the 401k still might work for you. But I get rules of thumb in general. If you want less paperwork, go with the SEP. If you're not afraid of a little bit of paperwork to get a little bit more money in faster, 401k is probably great. All right. Next, for a beginning startup company with a small profit, which plan is best? Probably the SEP. Probably the SEP. If the owner and spouse just started a business, contributed some working capital, and just started to get W-2 income from the same resources, does that qualify for a 401k or SEP-IRA for 2020? Which is preferred? Both are over 64. Yes, you can do either a 401k. So you still get to qualify for the solo 401k if only you and your spouse are the employees. Or you can do a SEP. Hopefully you can go back and watch some of the details that I've outlined about them all, to try and gather which is preferred. I don't think your age really factors in there, but it's going to be either the SEP or the solo 401k that I would recommend to you. The administrative burden of the solo 401k may be not worth it. One other thing occurs to me that I didn't mention earlier. Because of that administrative burden of the solo or of the 401k and the possibility of having to file a tax return for it, usually the fees associated with the custodian's fees for administering a 401k for you are going to be higher than with a SEP. So that's something that may tip you one way or the other, when you're inquiring about those plans. Okay, the 55 rule applies to SEP-IRA as well. The 10% penalty goes away at 59.5 in the SEP-IRA. The 55 rule, the over 50 rule, maybe you're talking about. The over, I'm not sure which 55 rule we're talking about there, but yes, the 10% penalty goes away after that retirement age kicks in with the SEP as well. Kind of all of these retirement plans, traditional IRAs, and these business retirement plans that we're talking about, generally follow the same rules when it comes to not being able to touch them until you retire, and the 10% penalty thing as well. Next question, does your business tax return have to be tied to your 1040 if you have multiple businesses? Or can you just file a Schedule C for each business? Schedule C is part of the 1040. You can have multiple Schedule Cs in your 1040. Yeah, not sure if that has to do with the retirement plan discussion, but hopefully that helps you out. Can exiting a personal IRA or 401k rollover be used for the business to contribute to? Oh, I see. So, well, you can't get a deduction twice for the same money. So if this money, if there were funds contributed to a personal IRA or a 401k, and you got a deduction for that when you contributed them, rolling those over into the business's new SEP, for example, is not going to count as the contribution, this year's contribution. It's just a rollover from one account to the other with no tax benefit or change in your taxable income. All right, looks like that's the end of our questions. We'll go ahead and start wrapping up. If you've got any last minute ones, please submit them right now. But we're going to close out today's webinar by thanking you for attending. We do these tax topic webinars every month, in addition to our client Q&A webinars that are conducted for clients who are signed up with us. So we'd love to have you join Mazuma. Obviously, we're all about the bookkeeping and the taxes and keeping you out of trouble with the IRS, right? That's what Mazuma's service is meant to be. And our vision, our mission is to do that for as low of a cost as possible, make it as affordable as possible for you, our small business owners. So check us out on our website, mazumausa.com. You can call us or submit a form there, and we can get on the phone and answer any of your questions. All right, so we got one last question that snuck in here before we leave today. The 25%, is that for gross profit or net profit? That would be for net profit. But really it's compensation. So it's net profit or the payroll that you're getting from the company. So it can be both, but it's definitely not gross profit, net profit, or the payroll that you're receiving from the company as compensation. All right, thank you for joining today. We'll see you next time.